I've had calls over the last 6 months with people that are losing their deals. We've been through 2008, COVID, the high interest rate market, the cycles come and go. It is part of investing. You can't take out the risk. So how do you prepare? How do you put yourself in a good position for when those things come?
Just make sure that no matter what's going to happen, you've done as much as you possibly can to shield yourself, your partners, your team from those elements that can and will destroy you.
Welcome everybody to Self-Storage Income, and today we're talking about survival, how to be hard to kill, how to last, which allows you to grow. Take advantage of the downsides and the upsides because you cannot control so much. You can only be prepared.
No, exactly right. And this is why we emphasize and focus so much on self-storage, on that micro market, that microeconomic element of storage and how amazing those things are. But no matter what we do with that micro market, there are those factors that will, can, and do impact you that might be these macroeconomic things. You know, it could be interest rates. It could be these things that we saw with valuations, all this stuff. I mean, we've gone through all of it, and I'm excited for this episode today to dive into some of those war stories, so to speak, and talk about this idea of being hard to kill. It's so important that, you know, when we're looking at deals and we're underwriting, I need to start reframing this. Like, you never look at deals, you look at opportunities, because deals are made, right? So like, I gotta stop saying deals. So when we're looking at opportunities, when we're underwriting, when we're looking at markets, we've got to buffer all these things in there. A prime example that I like to share with people, just first and foremost, is occupancies. You know, a lot of times you see in people's underwriting that they underwrite for 10% vacancy. You're like, well, you're just going to bank on your facility being 90% occupied all the time. That's a really, really dangerous expectation, especially, again, in our experience. I mean, we've seen stabilized assets go from 85+% occupancy to below 70 in certain markets and things. So those things do happen. It's really, really important to stress test your underwriting, to look at these things upside down and backwards, and just make sure that no matter what's going to happen, you've done as much as you possibly can to shield yourself, your partners, your team, all these things from those elements that can and will destroy you.
Yeah. You know, we've been through 2008, COVID, the high interest rate market, the cycles come and go. It is a part of investing that you can't take out the risk. Like, that doesn't exist, right? So how do you prepare? How do you put yourself in a good position for when those things come? And as much as you underwrite, as much as you look at the market, right, you don't know when interest rates are going to go to 8% and the market's going to shut down. You don't know when you underwrote to sell that thing at a 4 or a 5 cap in a 4th tier market, and then it goes to a 9 cap, right? Like, you don't get to control that. And should you have been underwriting it that way in the first place? And just because times were good doesn't mean that they'll last. And that's a lot what happened in the self-storage sector. Times were good for so long, people forgot. And the vast majority of people never went through 2008. Over 80% of all funds and people in it came in after, 2017. They only saw the upside. And that sets dangerous precedent. Now, the last 3-4 years have been super challenging. Now, people getting into it now, it's like an amazing time because the downside we've already seen. It's already been in. Cap rates have gone up, so you're buying deals cheaper. Rates have come down. Occupancies have come down, right? A lot of people didn't survive that. We've bought in the last 6 months, I don't know, right around 60 million probably. So we're talking probably over $4,000, $5,000.
A few thousand of them.
Yep. And, these are deals that they were losing. People were losing them. I've had calls over the last 6 months with people that are losing their deals. They're trying to get restructure, figure things out. And that's not from recently, that's from the past 3 years. And this is the same, when we went through 2008, we saw the same things. And we were able to take advantage of that afterwards. Even in COVID, we had a period of time that was devastating. We picked up amazing opportunities during that first 6 months of COVID, right? That was really bad when everything shut down.
Yeah.
Markets were on the border of freezing, right? Banks started loaning. Like, we don't, and you can't control those things. So how do you put yourself in a position to not just survive, but thrive? And that's the important thing. We have tried really hard in our firm to keep cash on hand, which allowed us to survive years of downturns, as well as take advantages of opportunity, and also be able to protect our investors from capital loss. Like, we've never done a capital call. We've never lost the investor's capital. Now, that doesn't mean that it wasn't hard and struggling, but we were actually able to step in and cover losses. Now, that's not a requirement or anything else like that, but I felt that that was important. But that came at capital losses to us and our firm. In fact, we've never made money for us and like our firm and how we did. I've never made ever money off of investors. It's only been our own capital, because the vast majority of the capital in our investments are capital. But it took us 20 years to get to a point where we could even be in that position, instead of letting assets go, instead of just being like, times are hard, right? No, to be able to push through them. And that was due to a few things. Diversification, that was due to our cash on hand, that was due to some of our underwriting practices and some debt, but we still got hit like everybody else. I mean, we're dealing with, last week, firms that, they've got over $1 billion, they're bigger than us, and they have a handful of assets they're losing. So it's one of those things where it affects everybody all the time. But with that said, you can protect yourself against some of those things and be able to take advantage of downturns. You can never fully get rid of risk. That doesn't happen. In fact, we don't get rid of risk, we manage risk. And that's the most important thing to understand. And that actually leads to the opportunity. The greatest growth our firm's ever had was through the down cycles. The deals that we're getting today, and now we're through that down cycle, are the best deals we've seen in over 10 years, bar none.
It's incredible.
After 2008, same thing, right? We went through a 5-year period where we were able to come in and we were buying deals and there was not another bidder. The last 4 deals we purchased, we were the only ones buying. These were off-market deals, people struggling. At the same time, you're also working on your individual facilities that are struggling. So we've had the rate drop that happened in the last 4 years was bigger than the rate drop during the great financial crisis of 2008. That's wild to think about, right?
It is, man. It's crazy.
Like, we had 2 markets where rates dropped 50%.
Yeah, you put that in your underwriting?
Yeah, exactly. Exactly. Well, go back and stretch it back to the worst time that it had ever been.
Yeah.
We saw rates go down by 9-10%, right? And that was the worst. And so this isn't meant to scare anybody or anything else like that at all. In fact, one of the best things is today we're at a point where that pain and everything, it's already gone through. We're at the other side, right? The market's rents, occupancies have stabilized. It's now at the turnout point. We've had supply constraint that has been massive supply. New supply's dropped off a cliff. So because what happens in those when rates drop and occupancy drop, that's due to drop in demand, but it's almost always tied to oversupply. And so what happens is, especially when you're dealing with REITs and big firms, they drop those street rates like crazy to get people in, and then they move up the in-place rates, right? That's new. They didn't do that before. That's largely due to, I think, the structure with technology, rate revenue management, and also due to the fact that Wall Street cared a lot about occupancy. Like, if occupancy was dropping, your stock got slammed. So then you prioritize those, you set up your financial engines, everything else. This has also brought on, though, a lot of pressure from the government. So we've got multiple states now that are looking at regulation.
Yeah, I saw you'd posted something just recently.
Yes.
I can't remember if it was New York.
New York and California.
Yeah.
Where they're like you're getting people in, and then you're increasing rates by 300%. Like Wall Street Journal had a thing on this in the self-storage industry, right? I hate that practice. I hate it.
Yeah.
It destroys markets. More importantly, it destroys trust with customers. It's a little bit of a bait and switch, right? You're like, move you in at $50, but then after you've moved all your stuff in and you can't get out, now your rate's going to go to $250.
That's a tough thing.
That's a tough thing, right? But then the problem is when you have the big players that are doing it, everybody else, you either do it or you don't survive. I tried in one of our markets where they dropped a $200 rate to $60. I tried to hold it off, right? We're talking war stories here. I tried to be like, we're not going to do this because I just thought the practice was horrible. And we quickly learned it doesn't matter. So we would have customers come in, and I was on site at these facilities talking to the customers. And they're like, yeah, okay, your rate is $100. And we're like, yeah, but we're not going to jack up your rate. We're not going to do all this stuff. And they're like, yeah, but they're $50. So it doesn't even matter. I'm moving there.
It's that front end funnel, man. They're just
Front end funnel.
price.
Price sensitive on the front end.
Yep. And that's especially the case when almost everything is online now.
Yes,
where you're just
exactly.
checking the price.
Checking the price.
Like,
they
cool.
move in online and they go in. That forces then everybody else to have to compete in that way. And because I held off and didn't do it, it hurt us, right? It was so new and everybody's like, what are they doing? Why would you ever do that? This isn't, and I'm like, no, let's just work with the customers, everything else. And that obviously doesn't play well. Now, if you look into third and fourth tier markets, so the smaller markets you go, the actual less rate drop we saw because you didn't have that institutional pressure. But that came from new supply in the market where they were trying to fill up, right? And that demand had been so high and kind of artificially high during COVID.
Right,
you had builders and developers that were coming in to flip and put product out and then sell it at CO or a certificate of occupancy, meaning as soon as you get your certificate of occupancy to open up your facility, they just sell it like it's full. And developers were making tons of money that way.
Just printing money.
Printing money.
That was the plan for a lot of them.
Yep. Rates skyrocket. Demand falls off a cliff because housing froze. Housing transactions went below 2008, right? And then all of a sudden they can't fill up. But they also can't sell it.
Value's gone.
Value's gone. And banks won't underwrite that. So then your buying pool's gone. And that put them into a really bad spot. Now that's more of a speculative type thing. Right? I don't like that. We don't want to do that. We build to own and operate, not to try to flip, because your tail end of that building is really, really long. You start your development project. When you open it, it's in a new market. And so that's what happened.
Yeah, that time frame from beginning to end, getting that certificate of occupancy, you're talking, you might be a couple of years, going through that process. I mean, you might be lucky to get it, a little less than that, but at the same time, demands can change. I mean, look at what interest rates have done over the past, if you look at any point in history, how much interest rates have changed in just a couple of years time frame. And again, new supply coming on the market. That's why we're always hounding this idea of, current and future supply when we're looking at market.
Current and future supply.
Yep.
What inventory is coming out that you need to be aware of, right? Because and lots of times, especially in low demand, you don't know how much that new supply will affect the market. So you got to be careful with that. And that can change what you get on your rates and your occupancy.
Have you been wanting to get into self-storage but struggling on the next steps to take? So you may not know, but I wrote a book that's hard to even call this a book. I mean, this is a manual. We're talking 400 plus pages, which include all sorts of information about how we have been in the self-storage industry. That's everything from how we got our first deals, to scaling, to buying deals in today's market, what's changed and what remains the same. This is an up-to-date book that shows you how the market has changed and how you can win today. This isn't simple, this is how you buy a deal. No, this goes into everything, including how you scale and create a self-storage business. You can get a physical copy, an ebook, or the audiobook, plus free access to bonus content at the end of each chapter. You can get it today. It's available on Amazon and other platforms in which you can follow the link.
Well, and then other people were doing things like they were cross-collateralizing assets and putting debt on when you could. That was when interest rates were really low. But then that created another problem, which is a practice, we've never done in our firm. We've never crossed collateralized assets. We've never taken on debt. Now, that's not really a problem anymore and hasn't been for the last few years because a bank would never let you do that, right? They're forcing you to put, our average LTV is like 50, 55%. High is like 70. Well, that's not even necessarily by choice. The banks force that. They're never going to let you,
they've tightened up a lot, man.
They've tightened up a lot, which is a good thing.
Yeah, for those reasons. For those failures, right, that people have had. Man, there's so many amazing things to unpack here, talking about risk. First and foremost, there is no eliminating risk 100%. There's no way that we could have ever estimated that rates would drop 50% in a certain market. There's no way that you can look at some of those things and in those black swan events and predict any of that. So that's why it's vastly important to
manage the risks.
Yeah, manage the risks and make sure that you're doing everything that you can to stack your reserves, to have that working capital, to put money back into the business and to invest in things that will create efficiencies and will create revenue and just create that value add strategy for you as you execute your business plans. Like you got to make hay while you can.
Yeah.
And there's no getting around risk 100%. So I just want everybody out there, as you're looking at facilities, as you're analyzing markets, work from the knowns, work from the controllables. Don't try to predict that, if rates go down 50%.
You don't know if they will.
You have no clue.
Yeah.
I mean, stress test whatever scenario you feel like you want to stress test and see what that might look like. Run through stuff like, hey, what if this did happen? How might we navigate that?
Yeah.
Because
you're lucky now though, because like risk now is lower than it was prior by far.
Oh,
right?
Yeah, absolutely.
I mean, when you were in a market where rents were going up 10% every single year, cap rates were 4%, that was the height of risk. New supply coming out all the time. Today, new supply is completely constrained. It's
So demand
still
is
coming
high.
out, but demand has been stacking year after year, and it's gotten high. Markets have stabilized, rents have stabilized, and another reason why risk is low is because you're underwriting them differently. We're not underwriting them at a 3% interest
these
rate.
magical like pro formas and things. And the other thing too, like talking risk and it sounds like doom and gloom when we're talking about all these people that failed through some of these hard times. But even the most recent, over the past, 4 years or so, where a lot of these folks got, storage was on fire. They got into it. Like you said, there was this artificial demand and rates were going crazy, values were going crazy. And a lot of people that we saw struggled through just that transition back to a norm.
Yes.
It wasn't even that the storage industry collapsed or there was major
going
downturns.
To a norm from a really, really high point.
We're talking like 90+% occupancies blowing up and revenue just increasing like crazy back to like 80s as far as occupancy and, stability in a way. And that's all it took to kill a lot of those individuals. And I mean, that's not a huge discrepancy.
No. And too, with that said, self-storage is still the lowest defaulting of any of the commercial real estate assets. It's by far, in fact. So like, even when you're talking about comparable, like there is no such thing as getting risk in investing. It doesn't matter. It's stocks, anything, right? Like stock market goes down, stock market goes up. Real estate, home values change, right? All of those things happen. And when you look at comparables, self-storage is still the lowest defaulting. And I think that's a really important piece to understand that when done right, you can manage risk a lot better. And there's things that you can do to survive and thrive when markets change. Once again, we're at the opposite side of this. So we're talking about like a lot of the struggle and stuff from the past.
Yep.
That's if you're looking to get in now, that's a great spot to be.
Oh my gosh.
Obviously. How many of us would go back to 2010 to buy, right? Like we're kind of in that mode. We're kind of in that situation. Supply is constrained and it takes a long time for supply to come out, years. So it takes the market to recover, rates and occupancy to go up, and then new supply comes out, but it still takes years. So what happens is that pendulum goes the other way and demand gets way more. That's not saying that interest rates are going to go down and the housing market's going to come up because you build for today's demand.
Yep.
So,
so important, man.
If that did happen, interest rates drop or the housing market doesn't go up to anything like we've seen. I'm talking just some historical norm. I mean, that at this point is like a doubling demand because it's from such a low point. So it's a good spot to be in today, to be buying, to be operating, to be structuring it right, and to take advantage of that upside. And once again, looking at that money on the table. Now, when we're talking about like survival and the horror stories, things like that, even through 2008, when we went through, we never lost a deal. And that was a tough time, right? We were in smaller markets, had smaller deals. Financing was a lot different, not just because it was 2008, but because storage was financed differently. But the problems in the market, a lot of these problems are external. So the internal problems in the industry of like supply, a lot of that has gone. Now, there's still supply hit areas, right? But once again, that new supply. Now, the external, we've seen more of this normal. That makes it easier for us to make projections. After 2008, it was a scary time to be buying it. When we were buying, people were like, what are you doing? You're buying real estate right now in like the worst market ever, right? Yeah, but the deal makes sense.
I was just going to say, man, I think this is really important that you're hitting on this because you said it was scary, and that's an emotional thing, right?
Yes.
It's an emotional thing to be afraid to see these things going on, and by all means, that's a signal to you to like check the boxes, make sure that things
absolutely
are what they should be, to do your due diligence and all the things that you should be doing. But at the same time, to that exact point, if you're going through, the numbers work, the deal is making sense from a logical standpoint, and again, you're checking the boxes. If the boxes are getting checked, man, they're getting checked.
Yes.
It doesn't matter how I feel about it.
There's so much noise out there.
Yeah.
And that the emotions on both sides, both being scared and being greedy, that kills investors, right? But when you look down at a good deal, and a good deal is a good deal, and you structure it in a way to where you have flexibility, it's really important to take out emotion and look at numbers and facts and have a good buy box and set rules and let that guide your decisions.
Yeah.
Markets are emotional things, right? And this is where a lot of people get killed. They buy too high, they sell too low. They make emotional decisions, right? People do this when markets go down. They just get scared and then they sell at the worst possible time. And it's really important to be like, hey, let's dive into this. What can we fix? What can we do, right? And that's what, today, and even after 2008, when we're looking at the numbers, we're like, okay, all the noise that surrounds us, that's on our phones, that's on the TV, lots of that fear-driven stuff has nothing to do with even what you're looking at. It's important to be very real about what you're looking at. So like some people, they want the deal so bad, they try to make it work. If it doesn't work, it doesn't work. You should stick to your rules, right?
Yeah.
Let the actual math, let your buy box and investing thesis guide you. And that's where you really start to see deals and opportunities and be able to pick them up. Worrying about, I hear people like, okay, yeah, but what if the dollar goes away? I'm like, what? Like, I can't, nobody knows. I can't.
An asteroid might hit the Earth.
An asteroid might hit the Earth. Exactly. You start to bring in things that have nothing to do with it. And I remember that so vividly in 2008. Everybody's like, but the world's going to end, right? Like banking system doesn't work. It's not that critique, fear was out of nowhere. And I think that's why it gets hard, because it's like, no, this is something to be worried or scared about. But at the end of the day, we have no clue or no idea. And for us, we're like, okay, if the financial system stops, if the dollar doesn't become the reserve, this is our least of our worries. We're all unemployed.
Yeah, there's going to be
nothing left. Like,
I
and this is where I get into those asymmetrical bet type situations where I'm like, you want to limit the downside, you want to recognize the risks, you want to structure it, and you want to look at the actual drivers of revenue at the core, the fundamentals, right? And you need to take out noise. And that can be hard. Yeah. Really hard.
Touching on that, man, like going through those times for you guys in that, right after 2008, when it seemed crazy that you guys were buying assets, what were those fundamentals that you looked at? Like those logical boxes that you guys could check that said this thing was a good deal or it wasn't? What did you look at that really gave you that confidence just to go ahead and move forward?
So the 2 times I think that were probably the most was right when COVID started. Nobody knew anything that was going on. The world was literally shutting down and going in lockdown. Like, whatever you think about COVID or anything else, it doesn't matter. The reaction was very real.
Yeah, it was wild. Like when it first kicked off, it was like, dude, I don't know. Maybe this is it.
Maybe this is it. Maybe we're all dead, right? Maybe, everybody's locked at home. The economy will never get going. There was so many questions and the fear was real. We can't leave government imposed mandates. Like it was, you can't bypass anything else. And when the Great Recession happened, it was very real. Unemployment was skyrocketing. Banks were failing. This isn't made up fear. That's not what I'm talking about here, right? So when we got down and we started looking at deals during 2008, we looked at the overall landscape. Okay, how has this held up? What are occupancies been? What is the drivers, the core drivers? Is there new supply or is there enough demand to where we see those levels and it's survived? What are rates doing? Supply, occupancy tied with rates and how they look in the work. Core demand. Do people live here? Are they buying? Are they renting? Right? Is there any growth? Measuring all of those things. So like, what are the actual eroders? What are the things that take away demand and take away your ability to charge rates? Are those occurring here? So are we losing population? Is there a massive increase in supply? Right? What are all of those things happening that actually hit those drivers within that area? I'm not talking about what's happening in New York. I'm not talking about what is happening in that local market. And when we looked at that, we're like, no, this is stable. And it has been, and we can look past and there's no new supply, things are growing. And so when we looked at that and we got down to the actual business of storage, those were sound fundamentals, even though there was so much chaos and noise outside. And, interest rates. Okay. So then we look at what's our basis? Can I lock in that interest rate for how long? So then I have a known, interest rates may go up or down. Yeah, but it works at this interest rate and I'm locked into this interest rate for 10 years, right?
It's a huge amount of value.
Then I know what that is, right? So we look at those things. Some of those markets failed that test. No, occupancy rents have been going down. There is new supply coming on. We don't have a growth rate. Unemployment has been going up. Okay, well, now all of a sudden those actual drivers are gone and the eroders are very real. So we got to check that one off. During COVID, we picked up a lot of properties that were in distress. So we picked up like a 5 acres office building and all buyers had just evaporated. Banks were on the verge of like shutting down. Loans were stopping. And so when we were getting it at the price we were getting it, we were looking at it and I'm like, we could scrap the building, everything else, and the land is worth more.
Yeah.
Like the land.
Yeah, right? Demo everything and just
exactly.
Yeah,
just
land is
sell
worth
the
more.
land. It's so the basis was so good that it allowed us to take on a lot and be totally fine. The backup plan was still really, really good if things went down. So we had our case today vastly undervalued. The reasons why it was undervalued, right? We did not believe were not only permanent, but even if they were permanent, the value was still below where it should have been. And so our basis and our spread on it, we're like, this makes sense. Even if we just hold it, we don't even need to do anything with it at all. And that obviously quickly resolved in our market, 6 months later. And 6 months later, it was worth double what it had been at that moment.
Yeah, once we got permits, that was another thing.
Yes, exactly. Yeah, permits.
Took a million years.
Yeah, it took a million years working with the cities because they were all shut down. But looking once again at the fundamentals, thinking long-term and saying, all these risks, we're talking about what is actually going on in this market. What are the core drivers? What are the eroders of value, occupancy, rent, demand, all those things? And what is happening right there? And then the fear-based over, does that actually apply or not? And that can be really hard to separate. really hard. But the numbers don't lie.
Yep.
You can measure it and you can look at it. Then you can set things up in place to make it so you have flexibility to go through any ups or downs. Look at those liabilities, your interest rates, your taxes, your insurance, right? Look at those. Are those correct? Are they right? Are they locked in? What is the variance for them? What is the spread on that of what's happening today, not future? We're not saying, oh, I believe that rents are just going to go up or occupancy's just going to go up. No, like today, what is the spread on it today?
Yep.
And then that gives you cushion and ability. You lock in the known liabilities, and then you can work to optimize the asset. And if things go up, then it's like, that's great. That's the cherry on top.
Exactly. And this is all just such incredible advice, because none of that ever changes. No matter what deal, no matter what thing you're looking at, no matter what is going on in the world, those are always those same fundamentals. It doesn't matter if it's 2008, if it's COVID, if it's now, all those different factors, like it could be gangbusters, it could be, doom and gloom. Those are the same exact things that you need to be looking at every single time you look at an opportunity. And that's the stuff that we've got to hit on. I do these one-on-ones with a bunch of folks and stuff. And a lot of times, people who are just getting into this asset class, it's like they've got an OM, they throw it up there and like, what do you think of this facility? It's like, well, so again, demand, let's start diving into this. Like, what is this market here doing where this facility's at? What are the competitors like, the supply, the demand, the utilization, and even, getting more and more granular, not in just storage demand, but the utilization demand, right? Like, is it boat RV? Is it actually traditional storage? Is it temperature control? Is it not? Like all these other things. Is it maybe it's a recreational town where people are just going there in a vacation town, just some kind of seasonality situation might be happening. And there's
understanding your product and your customer.
Yeah. And how they're utilizing it and when they're utilizing it. And like you'd hinted to, technology these days has allowed a lot of folks to be able to do these things in a way that we haven't before, from not just the rate management side, but from just an overall operations side, and being able to get that data and information to make informed decisions on rates and in managing that property and that asset in a way that maybe we couldn't before, because we couldn't see when somebody was accessing the gate or how many times somebody accessed a unit or those different things. And so
you've never had more information than you have today.
It's
wild.
So incredible, man.
It's so incredible. The amount of information, if anything, is too much. Like people are like, holy cow, I don't even know what to do with all of this.
Yeah, no, it's like, and you have so many solutions too, from property management to phone systems to all these things. Like there's a million service providers out there for all these things.
Yes.
And it's like, man, who do we use, and how do we put our tech stack together and all this stuff? If that's the biggest concern you've got, man, which I think, is definitely one of those for a lot of folks starting out, is just structuring things correctly. I just want to second what you're talking about here. This is an amazing time to get into it.
Amazing time to be in storage.
I think that there's the very real possibility. We've seen consolidation happening in the storage market, and I think it's happened at a faster pace than what was anticipated, 5-10 years ago. And I think with technology being where it's at, I think that will continue to compound in a way where people will be able to collect data, execute on deals or execute on opportunities more frequently and or more quickly and frequently. And I think that's, and again, right now is the time. Get out there and start doing these things, start analyzing the markets, use these stories that we're sharing with you guys about declining rates and using the knowns and stacking your reserves to make sure that you're hard to kill and can weather the storms. Don't just go out and buy all the fancy stuff. It's like be disciplined in saving that capital for the rainy days, not only for the bad and the down times, but also positioning yourself for opportunity. Like when you're scaling to that second facility it just gives you the ability to have flexibility in how you execute on the next deal, how you operate your current facility, that other companies, and there's so many of them out there that are just operating in ways that expose themselves to large amounts of risk that you don't have if you're doing those things in a disciplined way. And that's what is going to make you guys, hard to kill if you're doing those things correctly, being disciplined. And how incredible would it be to be able to be in those positions of opportunity, to put your head down at night, to be able to go to sleep and wake up the next day and not be sitting there, trying to figure out how you're going to survive.
But instead take advantage.
Exactly. Be positioned to take advantage of those opportunities.
And there's a problem with opportunity because it's counterintuitive, meaning that opportunity comes when everybody doesn't see it.
I mean, your whole story there in 2008 is a prime example.
Yes, that's when opportunity comes. If everybody is like, oh, this is amazing, this is easy, there's no risk, or there's very limited risk, that's actually the peak risk time. The opportunity in the lowest risk time is when less people are doing it, when there's less people trying to get it. The more people there are, the higher prices go. The higher it gets priced to perfection.
That was the whole post-COVID scenario.
Yes.
To a T.
To a T.
And that's where we're seeing the fallout of that.
Exactly. That drove things to an unreasonable level. And when you're in times like today, you have people that there's less buyers, there's less easy money. That actually all lends to opportunities, not the other way around. When it's 3% interest rate, money's easy to come by, banks will finance anything, and there's lots of people in the market, there's vastly less opportunity. So the things that people look at and are like, oh, this is bad or it makes it hard, I'm like, no, that's actually what makes it good.
And it sounds like we're talking a lot about like liquidity, and being able to have cash on hand and be able to, whether it's fronting bills or executing on potential opportunities or improving your operations and investing more in the company or the asset itself. Like, what are some things, some fundamentals of having that liquidity? Like, are you trying to get lines of credit? Are you just saving all the money? Are you going out and having like investors primed and ready to go? How do you have access and maintain liquidity?
There's a few things about liquidity that we've done. We've kept cash on hand. We've sold properties to have liquidity. We have cash flowing, diversification. But also too, it's part of the planning, meaning that a lot of people look at a property, oh, it's cash flowing. That just means every month I'm going to have money, where they forget that storage is cyclical. Some months are good. It's a business. It's not an ATM. And some months are good and some are not. So you need to have cash on hand to be like, all right, it comes in waves. But when it's good, when you have spring and summer and revenue and occupancies go up, that you are adding a certain percentage to the reserves, right? And you're filling up reserves both in your CapEx and your operating reserves, and that when you go into it, you have some reserves on hand, and that those reserves allow you to actually move that. Because when you're buying an asset and making changes, you also then have, if you're upping rents, people are going to move out. You have to turn out tenants, right? So developing, I mean, you absolutely have to have reserves. You don't know exactly when it'll fill up. You don't know when you're going to achieve certain rates. So a lot of people, we saw they were planning 6-month fill-ups, and we're like, what?
Yeah. No,
3 years. 3 years, always.
Yep.
We always plan on 3 years, no matter how good a market is. I need 3 years to fill that thing up. Now, with that said, it's never taken us 3 years to fill up.
Right.
Even in this market, our last two developments, we were at over 60% on both of them in under the first year. But we would never plan on that financially.
Never assume it.
You should never do that.
It's such a testament to that conservative approach.
Yes.
On your underwriting and expectations and that icing on the cake, like you talked about, whether it's rates or any of this stuff, like go on the knowns as best you can, but plan for worst case scenario. Like pro tip, that's just about the whole 3 years, like getting to stabilization 3 years from zero is just below like 3% a month in occupancy increase. So if you guys are out there underwriting and you've got a value add opportunity where you're increasing occupancy, maybe it's 2.5%, 3% on the high side, per month if you're looking at it and want to increase occupancy. Side note.
Yep. Some months will be bigger, others will be smaller. And so that's going to be your average and you should plan on it.
Yeah.
And that also goes to you're looking at vacancy fill up and you're saying, okay, well, if I increase rates, about how many people will we lose? And what is the break even for that? If I'm increasing rates by 10% and we lose 5%, well, that math is amazing, right? Because you're positive 5%, and then you have 5% more to fill up. So that's a win, right? But to be able to say, listen, we have the money for things that go wrong, gate breaks, a door breaks, right? We have the ability to take care of issues, go through a slow season, add money to advertising, moving people in. Filling up facility is more expensive because of the work that it takes, the capital that it takes to attract and bring in new people. It's not the same as a stabilized. So if you have a stabilized facility, but you want to reposition, you want to up rates, well, make sure you have marketing dollars allocated. Make sure that you aren't running at a 92% occupancy, even though you're aggressively upping rates. That's not reasonable, right? And so making sure you have that flexibility is good. Even on, the assets that we had when markets and rates just cratered. And some of those were a fill-up facility that we had. We had cash on hand to say, okay, we can lower expenses, even though when times get hard, expenses rise. That's the counterintuitive part. But we had cash on hand. We could hold out. We could take care of the asset. So we didn't have to do capital calls. We didn't have to do anything else. And you can make it through those times. And during those times, you're allocating money to improve the asset, to stabilize it, to get people in, that you can be competitive in the market, and then you can get it repositioned and get it moved up. I love the word flexibility. You have to allow yourself flexibility. And two, markets go down, they also go back up. And a lot of people vastly underestimate those swings. They underestimate the overall impact on revenue when it can kind of come down, as well as go back up. The compounding effect of occupancy and rates driving upwards is huge, right? So you need to be able to go through, stabilize, and then take advantage on the upside, start doing rate increases, figuring out which products you have, which units are of the most demand, so you can raise rates on them, not standardize rates or occupancy. You need to be flexible with those things so you can optimize the asset, right? That takes time. It takes time. It
truly
right?
does, man.
You got to go through busy seasons and slow seasons. You got to see what's working and what's not. Give yourself time.
We're talking years.
Yeah. Give yourself the ability to not knock it out of the park, to fail and still keep going, right? And if you have that ability, then you'll be fine. You can survive the downturns and you can take advantage of the upside.
For sure. And quickly, one last thing I want to add here is you'd mentioned gates and doors and all these things that are really, really expensive. That's another huge pitfall that I think people have a misconception of storage, is that you just don't have to do anything. That is not the case. No. Maintenance is a huge thing that you have to stay on top of.
People love driving into gates, doors.
Yeah, everything.
I don't know. It's like bumper cars.
Yeah,
like they go into a
100%.
storage facility and they're just like, there's a building. Crack.
Yeah.
Like
well,
all the time.
You guys literally had somebody drive through the building.
Through a building.
One of the
climate controlled indoor building, drove through doors right out the building, sliding the big glass sliding doors, automatic doors. Busted through them, drove out of the building.
It's insane.
It's insane.
Yeah. So plan for those things.
Yeah,
you got to have some reserves ready to go. And maintenance is definitely a big thing. So don't short yourself there.
And the idea is to not be scared, but be prepared and to look at the reality of the situation. People can get way too conservative too, by the way. They can never get a deal or anything else because they're like, it has to be just this screaming deal and it has to be so cheap that I'll always make a ton of money. That is not how markets work. You can be so conservative where all of a sudden you're running stress tests at 0. You probably shouldn't be buying it if you're doing that. So it needs to be realistic, both on the top end and on the bottom end, right? And you need to have reserves, but at the same time, the reserves can't be, well, we can survive for 3 years without any revenue. Well, then you're just wasting money sitting in a bank account, right?
Right.
What is your insurance levels? Like, how much do you have to cover? How much does a gate cost? Can you get it fixed up? Right? If you submit your insurance claims, how long does it take to get repaid? So do you have that working capital? And what is the spread? What are your deductibles that need to be put in? Right? Making sure you understand and you have it, and that you can fill up those reserves as you drain them, that you have some right out of the gate, but that you're not planning on a nuclear bomb going off at a level I get and you have nothing. So once again, I mean this on both sides. You can get too extreme and you got to avoid that. Look at the numbers, measure, don't guess, measure, give yourself opportunity that if a gate breaks, you're okay, right? That if during the winter season, you don't have as many people move in, you're okay and you can take advantage of the up season. That if you need more ad spend to fill up because you have some vacancy, that you have that allocated, right? So reserves, yes, but I'm not talking about holding entire expense loads for a year. That's not reasonable. That's not logical. And what that'll do is that'll put you to where you can never buy anything because an asset that's $3 million, you're underwriting, I can only buy this at $1 million or it doesn't work. Well, that's because you have 500,000 sitting in a bank account, right? That you need to have. So of course that's not going to work.
Right.
So don't be extreme. Look at your 3 to 5 mile area, find out what the real risks are, prepare, try to lock in all those liabilities, look at the past, occupancy, rents, revenue, see what you need as far as marketing, fill up, operations. What is that as a percentage of the revenue? What's your margin? And then what are the opportunities that are moving forward? And what is the cost of those opportunities?
All the knowns, man.
All the knowns.
All the knowns.
And then execute when you have opportunities and follow that business plan.
I love it, man. Fantastic info. If you guys enjoyed this episode, leave us a review. Comment
Please,
down below
that
any
helps.
thoughts you've had throughout watching this here, if you're on YouTube at all. And appreciate you guys. We'll catch you next time.
Thanks, everybody.